Yes, my good learners, welcome back again to this today lessons. And today we are going to look at the partnership, the further aspect of partnership. I remember you did partnership under the foundation level, right? And under foundation level, we just did the normal partnership where we have like ABC partners. These ABC partners are trading in another name, and then at the end of the period, these are three people who are going to share the profit, and that's all under the financial accounting. But when it comes to the financial reporting, it's somehow different, but the accounting concept remain the same. So here we are looking at the conversion, the partnership conversion. In the whole syllabus, we had a realization where we have a partnership, and then these partners, they might decide to sell their business. Then now, so you have to get those realization account. But with the current syllabus, we only remaining with what? The partnership, which is on the side of conversion. So when we say conversion here, we are meaning that you have the partners, that is the partnership as a company, the partnership as a company, the partnership as a company. And then maybe you have agreed as a partner to change this what? To change this partnership into what? A company limited into a limited company. So if you have decided to change this one, then examiner requires to have some accounts. Examiner requires to have some account. So the first account examiner will want you to have is the realization account. Is the realization account. The realization account, simply here we are comparing the asset and liabilities. Remember, when we are buying any asset for any company, there is what is called the purchase consideration. There is what is called the purchase what? The purchase consideration. This purchase consideration is the price of the company. So, and the price of the company, we value that purchase consideration based on asset and liabilities. So that's what we'll compare on realization account. And number two, we're going to look at the partner's capital account. We have to know how much each partners have in the capital account. Partner's capital account. You have to know the partner's capital account. Once you know the partner's capital account, you can go and have what is called business purchase account. This one will guide us now doing the purchase consideration. And we need to have the vendors account, so that in case there is any debt we need to write off, can be able to determine through the vendors account. So I think we will do an illustration for November 20. Let me check the past paper. So open with me the CISSE past paper sitting November 2019. So let's look at the illustration. Let's look at the illustration. Illustration is November 2019, that is CISSE. November 2019, question 1B, November 2019, question 1B, November 2019, question 1B. So we have been told Chanda, Pete, Tender have been in partners business for many years, sharing profit and loss in the ratio of 2 to 1 respectively. On 30th June 2019, The partners agreed to convert their business into that of limited liability company to be named Jabete Limited. The trial balance extract from the record of the partners as at 30th June 2019 was as follows. We have property at cost of 60,000, plant and equipment at cost 25,000, motor vehicle at cost 12,000, furniture and fitting at cost 4,000. Remember, there's some zeros, so it is 4 million. A provision for depreciation on 1st July 2018. Building 5 million, plant and equipment 13 million, motor vehicles 4.8 million, furniture and fixtures 1.6 million. Net profit for the year ended 30th June 2019 is 28.8 million. Trade receivable and trade payable on debit side, that is 18.2 million. Inventory on 30th June 2019 is 25.3 million. Cash at bank 8.12 million. Fixed capital account, we have partner 1, Janda 30 million, Pete 20 million, Tenta 10 million. Bank loan on credit 18 million. Current account Janda on credit 4.28 million, Pete 3.56 million, Tenta 2.34 million, and drawing account on debit side, we have a Chanda 1.58 million, Pete 1.17 million, and Tenta is 0.71 million. 0.17 million. Additional information number 1. Additional information number 1. The property, plant, and equipment in partners were being depreciated as follows. So that is depreciation. Was being depreciated as follows. Was being depreciated as follows. Asset, building, plant, and equipment, motor vehicle, we have rate. Building is 2%, straight line basis. Plant and equipment, 12.5, reducing balance. Motor vehicles are in 20%, straight line. Furniture and fitting, that is 10% straight line method. Depreciation for the year ended 30th June 2019 have not been provided for. Number 2, the partners were entitled to an interest on their fixed capital balance at the rate of 10% per annum. No salaries was to be paid to partners. Note number 3, the tangible and current asset were to be transferred to the new company at their values, fair values as follows. Property, 7 million. Plant and equipment, 16 million. Motor vehicle, 9.5 million. Furniture and fixtures, 3.5 million. Number 4, the current asset and liabilities were taken over by the new company at their book value. Number 5, the purchase consideration amount to 110 million was settled by the new company through the issue of ordinary shares of 10 shares each to the partners in satisfaction of the amount due to them upon the conversion. Required the realization account on 30th June 2019, the partners' capital account, and the opening statement of financial position of 1st July 2019 for the CIFA Limited company. So they need us to give the realization account. The realization account. So the first one, we need the realization account. Realization account. Remember, I said a realization account is all about asset and liabilities. It's all about the asset and liabilities. So we will debit all the assets and credit all the liabilities. Once we have done that, then we can take the difference and get it as the budget consideration. So what are the assets? So look at the asset at the beginning of the year. We have property, plant at cost 60 million. At cost 60 million, but you need to get at the at the net book value, property, plant, and equipment. Property, plant, and equipment. So look at the property, plant, and equipment. Any depreciation. Property, plant, and equipment. The cost. So you have the property. So you have the property there. Is a blurring of I hope you're able to check it. So we will record the asset and liabilities on the net book value. So we have property, plant, that is property. The cost of property is how much? That is 60 million. The cost of property. So here I have million. We have million here. So if you check the cost of this property is 60 million, and then we have accumulated depreciation of 5 million. We have accumulated of 5 million. What is the depreciation for this building? They said building, plant, a property, where is that? Building will provide depreciation on 2% on straight line. 2% on the straight line. 2% on the straight line. So you get the 2% of the straight line, how much? Get the 2% of the straight line. So get the 2% of the straight line. That is depreciation, 2% of the straight line method. So 2% of the straight line method to get depreciation, you will check, let me write, the cost of this depreciation is, we've been told it is, remember it is the building alone, not all the property as accumulated. So the cost of building is 50 million. They take 50 million times 2%. How much is it? How much is it? 2% of 50 million. I'm getting 1 million. Getting 1 million. So the depreciation charge for the year is 1 million. So I subtract that one so that I get the net book value of this property to be 60 minus 5 minus 1, getting 54 million, getting 54 million. Another asset, plants and equipment. Plant and equipment. The cost of this plant and equipment is 25 million. Depreciation of this is 13 million. That is accumulated. Depreciation charge for the year. Depreciation charge for the year. What is the rate of depreciation? Plant and equipment is 2.5 on reducing balance. So depreciation here, depreciation, we have been told 12.5 on reducing balance. So I will take 12.5 times the net book value of this asset. So the net book value, you subtract the what? You take the cost minus accumulated depreciation. You take the cost minus accumulated depreciation. So 25 minus 13, coming to 12. So times that rate, 12.25. I'm getting depreciation charge for the year. That is 150. 150. If you take all zeros, how like 3 zeros, 25 million. 500,000 minus 1300 minus 13,000, remaining with 12,000 times 12.5 divide by 100. We're getting 1.5. So depreciation charge for the year is 1.5. Depreciation charge for the year is 1.5. So if you subtract that 1.5, get now the net book value, 13 minus 25 minus 13 minus 1.5. We're getting 10.5 million. 10.5 million. What else? We have furniture. Take the cost of the furniture. The cost of the furniture is 4 million. Accumulated depreciation of the furniture and fitting is 1.6. Is 1.6. The rate of depreciation for furniture and fitting is 10% on straight line. So if it is 10% on straight line, you take the 4 million times 10%, which is 0.4. So here we subtract 0.4. So how much is the net book value of this asset? How much is the net book value of this asset? 4 minus 1.6 minus 0.4. The net book value of this asset is 2 million. So here I have 2 million. What else do we have as the non-current asset? So remember we have started with the non-current asset. I think that is all for non-current asset. Then we can go to the current asset. Current asset, we start with the inventory. So the inventory, we have the one which is opening inventory, 25.3 million. And then we have on additional information, inventory, not in inventory. So we check the inventory, 25.3 million. What else? We have the cash or trade receivable first. Trade receivable, we have not seen any bad debt, so that you can adjust. So you take that trade receivable, 18.2 million. 18.2 million. What else do we have as the current asset? Remember now the so let's have on credit side first. We can have the liabilities, trade payable. How much is the trade payable? Look at the trade payable and receivable on credit side. 14.7 million. 14.7 million. What else do we have? Bank loan. Bank loan is a liability. Bank loan is a liability. Ngapi? 18 million. 18 million. What else do we have? The capital, these guys, they introduced the business. They say the purchase, note number 5, the purchase consideration amount to 110 million was settled by the new company through the issue of ordinary share of 10 each to the partners in the satisfaction of the amount due, then upon the conversion. So we need to recognize the purchase consideration on the credit side. So this one is a good question. So you find that other questions, they give you the partners capital account so that you determine the purchase consideration. That is the balance figure. But for this one, they have given us the purchase consideration. We have purchase consideration of how much? That is 110 million. So we can balance now off this account. The credit side is more, 14.7 plus 18 plus 110. We get 142 million, 27 million. So we can balance off with the debit side. Remember, we balance off because this account is not the same. Debit and credit will not be the same. So what we do, the balancing figure, we share to the partners according to the profit and sharing ratio. So we will have the capital account here. The capital account, that is Chanda. We have 3 partners. Chanda Pete Tender. Chanda, is it Pete or Tender? These names are confusing me. Chanda Pete Tender. Those are all the three partners. They are sharing profit in their profit ratio is 2 to 1. So which will be 2/5, 1/5. the balancing figure. So how much is this one first? How much is that one? 54 plus 10.5 plus 2 plus 25.3 plus 18.2. You're getting 110. Getting 110. This one is 110. So I get the difference with this. Get the difference. So I will say 142.7 minus answer. I'm getting the difference is 32. 32.7. So we can now share that one times 32.7 times 2, we divide by 5. So the first one will get 13.0. Or 4 point what? So get that figure. Next, get the debit side, that is 54 plus 10.5 plus 4.8. Oh, that is the 4.8. The 4.8. There is an asset we skip here. There is an we skip here by getting something which is funny here. So look at there is an asset which we skip here. Did we really recognize the motor vehicle? Did we recognize the motor vehicle? Look at the motor vehicle. We have the motor vehicle here as a cost. Motor vehicle at cost, we have 12 million. Will be 12 million minus the accumulated depreciation of motor vehicle, 4.8. 4.8. How we have been told motor vehicle we charge 20% on a straight line, so it will be on cost. So if it is 20%, so it will be 12 million times 20%. We are getting how much? That is depreciation charge for the year. 12 million times 20%, getting 2.4. So here I will subtract 2.4 so that I get the net book value of motor vehicle. So the net book value of motor vehicle will be 12 minus 4.8 minus 2.8, getting 4.8. So previously, this one was 110. 54 plus 10.5 plus 2 plus 2, 25.3 plus 18.2 plus 4.8. So this one now come to 114.8 million. I take 142.7 minus answer, getting 27.82 again, 27.82 again, 27.82. 7.82. So let's look at, so let's confirm the asset. We have property, plant and equipment, motor vehicles. We have furniture, inventory, receivable, inventory, receivable. We have another asset which we have not included here. We include all the current asset. Look at the cash at bank. Cash at bank. Cash at bank. Cash at bank. Because if we skip any of the assets, then our account will not be in good terms. So that is 114. So I will get it again plus 4.8 plus 8.12. So now if you add this one, you get so the on debit side, if you add on debit side now, we are getting 122.92. Then we get the difference with this one, which will come to 142.7 minus answer, getting a 19. The difference is what we will share among the partners. So that one will be here. I don't have enough space here. So make sure you write it up here. We share up here. So right now the capital account, we have Chanda have the 10 and we have the 10 times. So we have to share the difference between the debit and credit according to their ratio. And then remember our ratio is 2 to 2 to 1. So this one will take 2 over 5, 2 over 5, 1 over 5. So 2 over 5 of how much? Of 19.78 million. So we are sharing 19.78 million. The difference between the debit and credit. So I will take times 19.78. It's 19.78. So